Joining us here at Post 9 is Citigroup Chief Investment Officer of Wealth, Kate Moore. It's her first interview since taking the role. We know you from BlackRock. It's good to see you in this new role. Welcome.
Thank you.
Congrats.
No, it's an exciting time to be starting the new role. I would like to say it might have been a little bit easier if I came in with less volatility, but I'd rather be entertained than bored. So.
Well, I know it's a big initiative of Jane Fraser to grow the wealth business.
Absolutely.
So that's where you sit now. What are you telling clients, high net worth clients, about this volatility and what they should be doing?
Look, we've all grown up in this era, particularly in the last 10 or 15 years, where buy the dip made a huge amount of sense. And I think there's a knee-jerk reaction from a lot of, advisors and bankers and our clients. What should I be buying at this moment in time? And the advice I'm giving right now is that we need to stay the course. Stay the course in the sense of not adding new risk and being really careful about the revisions that we're expecting to both earnings and to growth over coming quarters. So it's a much more cautious tone than I'd want to come out with at any other time. But the backdrop suggests that that's the right course. So,
what are you expecting in terms of earnings revisions and growth revisions?
Yeah. So, some people have pointed to very few earnings revisions so far and that the macro forecasts are only starting to come down a little bit for the second quarter. I think it's really too soon to tell what the impact from policy is going to be. And analysts, as we know, are kind of slow to make their earnings revisions. So I would think that as companies start to report first quarter earnings, as they give a little bit of guidance, or in some cases they remove their guidance, we'll start to see downward revisions to expectations for the full year. Now, one way analysts may do this is kind of take down first half earnings and keep second half earnings to keep their headline number high. But even still, I think that uncertainty makes it really hard to put new money to work and risk.
And so wait, I'm sorry. So either which is it? Buy the dip or
no,
don't.
We've all been conditioned to buy the dip.
Yeah.
I'm saying we don't buy the dip at this point.
Oh, you are saying don't do it.
That's right. The uncertainty level right now in terms of both policy, the macro implications, as well as earnings, make it really difficult to say we have an all clear in the market.
The shadow of this, the series of policy moves that we're anticipating and trying to handicap, obviously a big piece of what's been going on. But also, you have had this sort of narrow, highly concentrated market that was expensive start to broaden out just in a really messy way, right? I mean, so how do you diagnose what's been happening? And then are there opportunities that have been presented within it?
Look, I think the broadening out of the market has largely been technical. People have been rotating out of their high concentration positions. This is true for both kind of the fast money hedge fund crowd as well as, in some cases, the real money crowd. We haven't seen institutional asset allocators, though, make a significant change in terms of their overall risk. And that would be kind of the last shoe to fall. The broadening out is not coming because people have greater expectations for growth or because we're getting huge upward earnings revisions for some of these sectors. It is more like a rebalancing of overweights into neutral than it is actually a lot of conviction.
What are you telling people about the collection of Trump economic policies? There was so much optimism and enthusiasm about pro-growth policies like deregulation and taxes. And now with the introduction of tariffs and spending cuts at the federal government, which may be necessary, there are questions about growth. How do you add it all up as far as what it means for equities?
Just like everyone else, it's been really difficult to come up with a, perfectly clear forecast for how this is going to play out. On the one hand, this administration has expressed a willingness to allow growth in the market to be a little softer in the near term if they're achieving their longer term goals. On the other hand, we would expect some more pro-growth types of policies, maybe more in the medium term, certainly around taxation. But no one knows the timing and the cadence of that. And so, if I'm a company or if I'm an investor, it makes sense for me to kind of hold my cash at the moment and wait for greater clarity and not to say this is going to be on the 2025 policy agenda. It may be 26 or forward.
Buy gold. I mean, that seems to be working really well in this
Gold has performed really well. People, just as they've diversified out of like the high flyers in the equity market, have diversified to other assets in general. I would expect that trend to continue, but I don't have a strong conviction on gold at the moment from these levels.